Ladies and gentlemen, what you're about to hear will shake the way you think about money markets and your financial future. You see, most people are completely blind to what's brewing in the silver market, and I'm not talking about a little uptick or a short-lived bump. I'm talking about a seismic shift that could be upon us in the next 2 weeks, and if you're not prepared, you will miss it. Ladies and gentlemen, buckle up, because what I'm about to tell you isn't some clickbait title designed to get you to scroll another tab or some gimmicky prediction that will be forgotten tomorrow. No, what's coming for silver, and by extension, the entire financial world, is real. It's right around the corner. You honestly don't know what's about to hit silver in the next 2 weeks, but you will. And once you do, you'll understand why this moment could define the trajectory of markets for years. First, let's get one thing straight. The mainstream narrative around precious metals, especially silver, is completely upside down. Most people still think of gold and silver as mere hedges against inflation or something sentimental, a relic of old money thinking. They talk about Bitcoin like it's the only legitimate store of value and dismiss silver as the poor cousin to goldy, industrial, messy, too volatile, too unpredictable, too uncertain. But that's exactly why silver is about to move, and move violently. You see, while everyone's eyes have been glued to stocks, crypto, interest rates, jobs reports, and whatever the Fed tweets this week, the real story has been quietly unfolding beneath the surface. Silver occupies a unique corner of the market. It's both a monetary metal and an industrial metal. Unlike gold, whose demand is primarily investment-driven, silver's demand comes from industry, from solar panels to 5G infrastructure, from electric vehicles to cutting-edge manufacturing. That means every economic shift, every technological advancement, every disruption to supply chains, it all hits silver twice. And make no mistake, we are in the middle of massive structural change. We are seeing a global pivot away from fossil fuels that is accelerating demand for photovoltaic cells. Silver is the essential ingredient in solar technology. You could take all the platinum, palladium, and rhodium in the world, and without silver, solar panels just don't work the same. And guess where solar installations are growing fastest? Not in some sleepy backwater. In China, India, the US, Europe, every major economy is racing to install solar capacity faster than ever. That's not speculation, that's industrial reality. Then consider this supply. Silver mine production has been stagnant at best, declining in many regions due to geopolitical risks, rising costs, and environmental pushback. Mining companies, pressured by investors to prioritize profits over output, have cut back on new projects for years. They don't invest in new capacity when metals are cheap. And guess what? Silver hasn't been for a long time cheap, not in real inflation-adjusted terms. So supply is not growing, demand is exploding. Classic economics tells us prices go up. Yet the paper silver markets, the futures, the ETFs, the speculators have kept pricing locked in an illusion that everything is stable. But illusions have a way of breaking. And now we reach the crunch point the next 2 weeks, not out of thin air, but because a seismic shift is brewing beneath the veneer of market calm. You see, the ratio between silver and gold, the venerable gold-silver ratio, is at extremes not seen in decades. Historically, when that ratio stretches too wide, it has only one way to correct. Silver must rise dramatically relative to gold. And when silver catches up with gold, the percentage gain is staggering. But this isn't just about ratios. It's about real-world demand meeting real-world scarcity. Paper silver markets are thin. The COMEX inventories hit historic lows months ago. ETF holdings aren't shrinking because demand is weak. They're shrinking because holders are converting paper claims into physical metal, or they're refusing to sell at the current prices. Have you noticed premiums on physical silver bars and coins rising? If not, you will soon. In the next couple of weeks, as institutional players begin to realize just how tight physical availability has become, premiums will spike. Dealers will struggle to keep bullion on the shelves. Prices will gap higher as the market transitions from a paper illusion to physical reality. And here's where the average investor drops the ball. They'll hear about the move after it's begun. Once the headlines start screaming about unexpected silver surge, historic supply squeeze, prices explode, and they'll jump in at the top, chasing gains that others made early. But those of you listening right now have a chance to understand before the masses. make no mistake, this move won't be linear. There will be wild swings. There will be skepticism. People will say, this is just another silver spike that fizzled out, but the underlying dynamics have changed. Industrial demand isn't going away. Monetary demand isn't going away. Supply constraints aren't going away. And while the broader markets, stocks, bonds, crypto, continue to defy logic and gravitate around central bank whims, silver is anchored in real value, in actual physical use and scarcity. That's why gold investors always respect silver, not as a cheap gamble, but as the canary in the monetary metal mine. When silver moves aggressively, gold follows. And when gold follows, markets start to shake. So what should you be paying attention to? Watch industrial demand indicators. Watch solar deployment figures, watch inventory reports, watch premiums on physical metal, watch the gold-silver ratio inch closer to normalization, and most importantly, watch sentiment. When investors start saying silver is finally catching up to gold, that's the middle of the move, not the beginning. Right now, we are in the quiet before the storm. The next 2 weeks will reveal how tight this market really is, and once it breaks, once the squeeze becomes undeniable, there will be no putting the genie back in the bottle. You don't know what's about to hit silver, but you're about to find out. And when you do, the question won't be if silver soared, it will be how you reacted before everyone else realized it was coming. Thank you, ladies and gentlemen. What most people still fail to understand is that monetary policy doesn't just influence the economy. It redefines reality itself. It reshapes how people think, how they invest, how they save, and ultimately how they survive. And right now, that reality is being rewritten in real time, right in front of our eyes. While most people are distracted by stock market highs and carefully scripted reassurances from central bankers for decades, we've been told that inflation is temporary, that money printing is harmless, that doesn't matter, and that central banks have everything under control. These ideas have been repeated so often that they become accepted as truth. But repetition doesn't make something real. It just makes people stop questioning it. And that's exactly how we ended up here in a world where economic fundamentals have been replaced by monetary illusions. When central banks suppress interest rates below their natural level, they're not stimulating growth. They're distorting it. They're sending false signals to the market. They're telling borrowers that capital is abundant and cheap when it isn't. They're telling governments that deficits don't matter when they absolutely do, and they're telling savers that prudence is foolish while speculation is rewarded. That's not policy. That's social engineering through money. Think about what zero and near zero interest rates have actually done. They didn't create real wealth. They inflated asset prices. Stocks, real estate, bonds, all pushed higher, not because productivity improved, not because innovation exploded, but because money became artificially cheap. That's not capitalism. That's a monetary hallucination. And like all hallucinations, it eventually fades, usually painfully. Now layer on top of that the most aggressive monetary expansion in modern history, trillions of new dollars created out of nothing, injected directly into financial markets and government spending, no savings, no corresponding production, just keystrokes. And people are surprised that prices are rising. Inflation isn't a mystery. It's the inevitable consequence of debasing the currency. You don't need complex models to explain it. You just need honesty. But here's the critical point most commentators miss. Inflation isn't just higher prices. Inflation changes behavior. It erodes trust in money itself. When people realize their purchasing power is shrinking, they stop thinking long-term. They stop saving. They start speculating. They rush into anything that looks like it might go up faster than the currency goes down. That's how bubbles form, not because people are greedy, but because the monetary system punishes patience. And central banks, instead of acknowledging their role, double down. They tweak definitions. They adjust formulas. They tell you inflation is cooling because it's rising slightly less fast than before, as if that's somehow comforting. Meanwhile, the cost of living keeps climbing. Wages lag behind, and the middle class quietly gets squeezed. This isn't an accident. It's the outcome of policy choices. What's truly dangerous is that monetary policy is now being used to mask structural problems rather than fix them. Instead of allowing recessions to clear malinvestment, central banks try to eliminate economic pain altogether. but pain is a signal. It tells you something is wrong. Suppressing it doesn't solve the problem. It makes it worse. The longer you delay the correction, the bigger and more destructive it becomes. And let's talk about debt. Governments today operate under the assumption that debt can grow forever as long as interest rates stay low. That's a fantasy. Low rates are not a permanent feature. They're a policy choice. And once inflation forces rates higher, the cost of servicing that debt explodes. At that point, central banks face an impossible choice: fight inflation and crash the economy, or inflate the debt away and destroy the currency's credibility. Either way, reality reasserts itself. This is why monetary policy is reforming reality. It's changing what people believe is normal. Massive deficits are necessary. Currency debasement is stimulus. Asset bubbles are wealth effects. And anyone who questions it is labeled outdated or alarmist. But reality doesn't care about labels. It cares about math. And the math doesn't work. Eventually, markets stop believing the story. Confidence breaks. And when confidence in fiat money breaks, people look for alternatives, not because they're ideological, but because they're practical. They look for things that can't be printed, that can't be diluted by policy meetings or press conferences. That shift doesn't happen overnight, but when it gains momentum, it's unstoppable. We're not heading toward a return to normal. We're heading toward a reckoning with the consequences of pretending normal didn't matter. Monetary policy can distort reality for a long time, longer than most people expect, but it can't rewrite economic law. It can only delay it, and when reality finally reasserts itself, it won't ask permission. It won't wait for consensus. It will arrive all at once, exposing the fragility beneath the surface. The question isn't whether this happens. The question is who understands it early and who is left trying to figure out what went wrong, wondering how a system built on promises collapsed under the weight of its own illusions. Ladies and gentlemen, history doesn't repeat itself perfectly, but when it comes to silver, it has a very clear habit of reminding people what they chose to ignore. And right now, silver is standing at the edge of one of those moments, a historic catch up that most investors won't recognize until it's already well underway. The irony is that all the evidence is right there, hiding in plain sight, dismissed as irrelevant because it doesn't fit the comfortable narrative people have been sold for years. For a very long time, silver has been treated as an afterthought. Gold gets the respect, the headlines, the central bank attention. Silver gets shrugged off as volatile, industrial, too small to matter. But that misunderstanding is precisely wisely why silver's catch-up phases are always so dramatic. When silver moves, it doesn't politely adjust, it explodes. And it does so because the market has spent years suppressing its value relative to both gold and reality. Look at the gold to silver ratio. Historically, silver traded far closer to gold than it does today. For centuries, the ratio hovered in ranges that now seem almost unimaginable. Today's extreme imbalance isn't a sign that silver has lost relevance. It's a sign that price discovery has been distorted, and distorted prices don't stay distorted forever. They correct often violently. What people forget is that silver isn't just cheap gold. It's something far more dangerous to ignore. It is both a monetary metal and an industrial necessity. Gold can sit in vaults untouched for decades. Silver gets consumed. It gets used up in electronics, medical devices, solar panels, electric vehicles, and advanced manufacturing. Every year, large portions of silver supply are gone forever, dispersed into products that are never economically recycled. That alone should make silver more expensive, not cheaper. Yet the market prices it as if supply is endless. This disconnect exists because paper markets dominate perception, futures contracts, ETFs, derivatives, layers upon layers of promises to deliver silver, none of which require actual physical metal to change hands. As long as confidence in those promises remains intact, the illusion holds. But history shows that illusions break when stress appears. And the stress is building at the same time silver has been ignored. Monetary conditions have deteriorated. Currency debasement isn't theoretical anymore. It's lived experience. People feel it every time they shop, every time they pay rent, every time they look at bills rising faster than incomes. That erosion of purchasing power always drives people back toward hard assets. Gold gets the first wave of attention. Silver comes next. And when it does, it plays catch up at a speed that shocks even seasoned investors. That's because silver is a much smaller market. It doesn't take central banks or trillion-dollar funds to move it. It takes marginal demand overwhelming thin supply. And when investors who missed gold's move start looking for leverage, silver becomes the obvious target. Historically, in precious metal bull markets, gold moves first, silver lags, and then silver outperforms, often by multiples. That's not speculation. That's pattern recognition. What makes this moment different is how long silver has been suppressed. The longer the spring is compressed, the more violent the release. Years of underinvestment in mining, rising production costs, geopolitical disruptions, and environmental restrictions have constrained supply. Meanwhile, industrial demand keeps growing, not shrinking. Green energy alone represents a structural, non-cyclical demand increase. Solar panels don't care about interest rates or market sentiment. They require silver, period. Yet, despite all of this, sentiment towards silver remains lukewarm. Analysts still call it risky. Financial media still treats it as a trade, not a store of value. That tells you we're early, not late. True tops are marked by excitement, not apathy. When everyone loves silver, the move is over. Right now, most people barely care. The catch-up won't be gradual. It never is. One moment silver is ignored. The next, it's racing to close decades of undervaluation in months. And when that happens, the explanations will come after the fact. Commentators will scramble to justify why silver suddenly matters again, but the reasons were always there. They were just inconvenient. This isn't about timing a perfect entry or predicting a single price level. It's about understanding asymmetry. Silver doesn't need everything to go right. It only needs reality to reassert itself. It needs investors to question paper promises. It needs inflation to remain stubborn. It needs industrial demand to continue doing what it's already doing. None of that requires optimism, just honesty. Silver's historic catch up isn't a prediction pulled out of thin air. It's the inevitable consequence of years of neglect, distortion, and misunderstanding. The market can ignore fundamentals for a long time, but it can't erase them. When the gap between price and reality becomes too wide, something has to give. And when silver finally starts closing that gap, people won't ask why it's rising. They'll ask why they didn't see it sooner. By then, the catch-up won't be a story. It will be history. Ladies and gentlemen, if you really want to understand what's going on, not just in markets, not just in silver or gold, but in the global economy itself, you have to step back and look at the bigger picture. Most people don't do that. They get lost in daily price moves, headlines, central bank press conferences, and short-term noise. But history is shaped by long-term forces. And right now, those forces are moving in a direction that should make anyone paying attention deeply uncomfortable. For decades, we've been living off borrowed time and borrowed money. Economic growth has been confused with debt accumulation, and rising asset prices have been mistaken for rising prosperity. This illusion has been carefully maintained by central banks who learned long ago that if they can keep markets calm, most people won't ask uncomfortable questions. But calm markets don't mean a healthy economy. Sometimes they mean the opposite. The foundation of the modern financial system is faith in fiat currencies, faith in central bankers, faith that governments can spend without consequence and borrow without limit. That faith has been abused. When money can be created at will, discipline disappears. Politicians promise more than the economy can produce. Consumers spend more than they earn. Corporations borrow not to invest productively, but to buy back stock and inflate share prices. The system looks strong on the surface, but it's hollow underneath. The bigger picture is that we've replaced real savings with credit and called it progress. In a healthy economy, savings fund investment, capital flows toward productive activity, interest rates act as a signal rewarding patience and penalizing waste. But when central banks manipulate rates, that signal is destroyed. Capital flows not to what's productive, but to what's fashionable. Bubbles form, resources are misallocated, and eventually the bill comes due. Inflation is not an isolated problem. It's a symptom of deeper rot. It tells you that too much money is chasing too few goods, that consumption has outrun production. And when inflation shows up, central banks pretend to fight it cautiously, reluctantly, because they know the truth. They know that genuinely tight policy would expose how dependent the entire system is on cheap money. So they walk a tightrope, talking tough, while quietly hoping inflation erodes the debt for them. But inflation doesn't solve the problem. It just shifts the cost. It punishes savers, wage earners, and anyone living on fixed income. It rewards debtors and speculators. Over time, it reshapes society. People stop planning for the future because the future becomes uncertain. Trust erodes, not just in money, but in institutions themselves. That's part of the bigger picture most economists conveniently ignore. Globally, the cracks are widening. Countries that once trusted the dollar are rethinking that dependence, not out of ideology, but out of necessity. When a reserve currency is weaponized, confidence suffers. Trade arrangements change. Reserves diversify. This isn't an overnight shift, but it's a structural one, and structural changes don't reverse easily. Meanwhile, markets continue to behave as if none of this matters. Stock valuations assume permanent stability. Bond markets assume inflation can be controlled without pain. Crypto markets assume trust can be coded into existence. All of them assume central banks can continue to defy economic gravity indefinitely. That assumption is the real bubble. The bigger picture is that we're approaching a point where choices can no longer be postponed. You can't have high debt, high inflation, low rates, and strong growth all at once. Something has to give. Either currencies lose credibility, or markets reprice dramatically, or governments are forced into austerity they've spent decades avoiding. None of these outcomes are comfortable, but all of them are plausible. What makes this moment so dangerous is complacency. People have been conditioned to believe that every crisis will be met with more liquidity, more stimulus, more support, and for a long time, that belief was rewarded. But policies that work in the short term often fail spectacularly in the long term. The longer imbalances are allowed to grow, the more painful the adjustment becomes. Understanding the bigger picture isn't about fear, it's about clarity. It's about recognizing that the system we're in was never sustainable, only manageable for a while, and that while markets can ignore fundamentals, they can't eliminate them. At some point, reality reasserts itself, not gently, not politely, but decisively. And when it does, the narratives that once seemed unquestionable fall apart overnight. The people who saw only the surface will be confused. The people who understood the bigger picture won't be surprised. The real question isn't whether change is coming. It's whether you're willing to see it before it forces everyone else to. In the coming weeks, when silver finally breaks free and the price action accelerates, don't be the person scratching their head asking, why didn't I see this coming? Because now you know what's about to hit. Silver won't be an accident. It won't be random. It will be the predictable consequence of decades of monetary mismanagement. Stay alert, stay informed, and don't let the crowd dictate your financial destiny.